Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. I trust your week has been going well, and now we're here, what we've all been waiting for all week, the Federal Reserve's FOMC meeting tonight to decide monetary policy in the United States of America. Well, we mostly expect no rate hike, but what would happen if there was a rate hike? I would suggest equity markets may not recover from such a blow. But already, of course, people are starting to open their minds to the idea that there is, in fact, another Fed rate hike coming, whether it's this meeting, the second, third, or fourth meeting from now. And I tend to think it's going to be the second or third meeting from now and not tonight. However, the last two big data points, which I think the Federal Reserve will be paying a lot of attention to, were the inflation numbers, and they were very strong. We've seen significant re-acceleration in the United States from 3.0 headline inflation to 3.7%. And now just in the last 24 hours, we saw Canada reporting a huge single month jump from 3.3% headline inflation to 4% inflation. So it's now going to be clear to the Federal Reserve Committee meeting that this is in fact a global phenomena again, and it means that what it shows really is not just energy prices, oil prices are higher and it's feeding through inflation. What it's showing is that there's no room for maneuvering within the economy or businesses to absorb higher energy costs. If they get higher energy costs, they're already struggling and so tight in their pricing that they simply have to pass it on rather quickly. And that means that the headline inflation number and the core with a lag are going to be very, very vulnerable to the global oil price, which, as we know, has continued to rise since the last CPI data in the United States. So the Federal Reserve will be left with the quandary of, do they wait a few meetings because they don't want to be seen that, blindly aggressive central bank anymore to raise rates again, hoping the oil price will fall back, energy prices will placate, if you like, or do they go, you know what? We were behind the curve last time. Maybe we need to be actually aggressive at this Federal Reserve meeting, raise interest rates 25 points, and say that we're hoping this will be the new normal for quite some time, but it was necessary because of the re-accelerating inflation in what still appears, at least on the surface, to be a tight labor market. We also saw in the US yesterday that housing starts collapsed a further 11% last month, and that is on top. That basically brings the market down in terms of housing starts in the US 25 to 30% from the peak. So that could help stay the Federal Reserve's hand on tonight's decision later today in the United States, Europe. But I think it should, but it's no longer as clear as it was even at the start of the week that the Federal Reserve will not raise interest rates this meeting. My central core forecast remains that they will remain on hold this meeting, but be very aggressive in their tightening rhetoric, and that is the most probable scenario. However, I wanted to bring it to everyone's attention out there that there is a growing risk the Fed could actually hike tonight. Now, in terms of market behavior, the market traders and investors will be well aware that markets had come to grips with even the Fed actually raising interest rates in the recent cycle, and still for stocks to be able to rally. But that was when there was a backdrop of that false sentiment, which I continually flagged, that the US economy was strong and that the US economy would quickly return to strong growth, and that the Fed would in any case be cutting interest rates a little bit further down the track. None of that sentiment, none of that common group think coming out of the ivory towers who have no idea about Main Street, Wall Street, none of that has eventuated the way the bulls thought it would. And they are a little burnt and scarred now. So I don't think there's going to be quite the enthusiasm as there was previously to simply buy stocks regardless of what the Fed does. I think there's a growing realization the US economy is in diabolical shape, as those housing starts numbers show, and a whole lot of other data as well. Though it is good to see manufacturing stabilizing at a contracted level, but at least showing some signs of stabilization. But even that stabilization may not last in the face of higher global oil prices and renewed inflation pressures generally, which are really going to hit consumers and demand for products. So the Federal Reserve should be very aware of all of that, but its approach previously was very blinkered to just fight inflation. If it still has the same approach, and remember, it had to do this fierce interest rate hiking cycle because it had no idea in real time. You'll remember I was saying inflation's not transitory. If you remember, I called it a tsunami that was going to sweep around the world when everyone else was talking about inflation being transitory, and that's exactly what happened. And the Federal Reserve got badly burnt by that. Its reputation did. So that painful experience on credibility in the marketplace and around the world for the Federal Reserve, it could factor in to today's FOMC meeting, where the Fed may simply not want to be caught flat-footed ever again and may err on the side of caution to actually raise interest rates at this meeting. So I put it at about 35 to 40% probability of a Fed hike and a 60 to 65% probability that they stay on hold, but they're very strong on the rhetoric. And if the oil price keeps moving higher, they will probably hike at the very next meeting and not delay any further than that. I hope this helps. But in terms of price action, I guess the point I was going to make is, even if there is some knee-jerk response rally, if they stay on hold, they don't hike, and the market rallies, that could be a selling opportunity. Thanks very much. Have a great day. Clifford Bennett, Chief Economist.